Today on Escape the Clock, we're aiming to answer the question, how do you turn the largest illiquid asset in your life into the cash you need to fund your financial freedom? Total home equity held by Americans aged 62 and older has hit an all-time high of $14.6 trillion. The median homeowner in their 60s has accumulated over $250,000 in housing wealth, 47% more than in 2019. That is roughly 5 times the median retirement savings balance for the same age group. And yet Vanguard's latest research finds that only 40% of baby boomers nearing retirement are on track to maintain their current lifestyle. The typical near retiree is staring at a $9,000 annual income shortfall. And most of them are sitting on $250,000 in equity they were never taught to deploy. So why are millions of Americans treating their home like a museum piece when it could be the engine of their retirement? To answer this, I'll be joined by Ken Pitts, a 33-year veteran mortgage lender and the author of Kinetic Wealth, a book that makes the case that your home is not a hard asset to leave behind for your children. It's a financial tool that can fund your freedom while you're still alive to enjoy it. So today, we get into what home equity actually is, the myths, the realities, most importantly, how it fits into a real retirement plan. Stay tuned to learn how to stop treating your biggest asset like a frozen monument and start putting your home to work for your financial freedom. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. There is an asset hiding in plain sight in almost every retirement plan in America. It's the largest single asset most households own, and it has appreciated dramatically over the last decade. The vast majority of people pursuing financial independence treat it as untouchable, something to pass on to their children, not something to put to work for themselves. That asset is home equity, and the reluctance to engage in it is costing people real money. Consider the math. Vanguard's research finds that only about 40% of baby boomers nearing retirement are on track to maintain their current lifestyle. The median 61 to 65-year-old faces a $9,000 annual income shortfall in retirement, a 24% gap between what they have and what they need. Yet 85% of baby boomers own their own homes. For lower income boomers in particular, housing wealth represents 3.8 times their annual income, dwarfing their retirement account balances by a significant margin. The retirement gap is not just a savings problem. For millions of Americans, it's a planning problem, and the solution may already be paid for. Most of us were never taught to think of our home as anything other than a place to live and an asset to eventually sell. The idea of putting it to work while we're still in it can feel either too complicated, too risky, or frankly, too good to be true. But there's a system for doing exactly that, and it's been hiding in plain sight inside the mortgage industry for decades. Today's guest has spent 33 years helping families finance homes, and somewhere along the way, he realized that the home itself was the most underutilized asset in the retirement plan. He went deep on the research, built a framework for deploying home equity strategically, and wrote it all down in a book called Kinetic Wealth. Ken Pitts is a veteran mortgage lender, financial educator, and the author of Kinetic Wealth, a book that is reframing how Americans think about the relationship between their home and their financial freedom. Ken, welcome to Escape the Clock.
Daniel, thanks for having me.
You spent, 3 decades helping people getting into homes, and you had this realization that you could do more there. Can you take me back to this shift in the way you were thinking and what you were doing with your clients?
Yeah, so most folks in the financial services business, mine is no different than like a financial planner, for example. You kind of carry folks 15 years younger than you, 15 years older than you. That's the bell curve of your client base, and they kind of move through life with you if you've done a good job and you're getting referral business. And what I was starting to find as I hit my late 50s, I was getting more and more calls from clients who were my age asking me questions about these loans that their parents got into, known as reverse mortgages. Now, I was familiar with them, and I could walk them through, what it was. But basically, a lot of times they would say to me, well, why did my parents do this? What good is this loan? And I would say, hey, did your mom or dad ever come to you needing financial assistance? And they'd say, well, no. I said, because they took care of it. They took a reverse mortgage out so they wouldn't have to bother you. And then I would proceed to explain to them how it worked and what it was. But now I'm 63 and kind of made the decision like, hey, those folks that are in my bell curve, we're all in this now. We're all in this period of either being retired, thinking about retirement, really close to making those decisions. I really got to school up. And so I took that deep dive into the reverse mortgage product as a result and found myself super frustrated with misinformation, knee-jerk reactions of that's a bad loan, talking to my financial planning clients and getting the same reaction out of them. I was like, what is going on? And as I got really deep into it, I was on a podcast with somebody. We were talking about reverse mortgages. And after the podcast, that gentleman had said to me, you need to write a book on this. And so that's kind of where it all came from.
The old, you have to write a book on this, and then we have to go and spend part of a year writing a book. Yeah, I'm familiar with it. Yeah. Let's start with the home equity piece, because like I mentioned at the top, right now, the median home equity for Americans age 65 and older is $250,000. That was a Vanguard study that was done with Harvard Joint Center for Housing. And that's $250,000 is a lot of money for people and their lives. So let's start with the basics, especially for those that might be a little bit unaware of this. What is home equity and how could it be leveraged as like a financial tool?
So all of us at one time or another, and some people have been able to buy a house for cash, and that's awesome. But most people took out a loan. They took out some type of purchase financing. So they didn't own 100% of the house. They owned a percentage of that house. And depending on how much money they put down, maybe they started off owning 20% and financing 80% or 50%, whatever. The part of the property that you made as down payment was your equity. That's what you put into the property. It's the difference between the value of the property and where your mortgage is. And over time, as most people would see in any good financial planning chart, the value of real estate, although it takes hits from time to time, generally is a pretty recession and inflation resilient investment. It just goes up. And as a result, people's equity, how much of the value of the house that they own, gets larger and larger over time. So if I'm looking at a house worth of $500,000 and I owe $50,000 on it, I'm retired, I've paid it down, I only owe $50,000. There's $450,000 worth of equity in that $500,000 house. Well, that's real value, real dollar value. And that's really what we're looking to get when we get into a reverse mortgage. It's tapping into that home equity. Because if you really look at your house as a hard asset investment, it's not easily liquid. You either have to sell it or somehow you got to borrow against it. And that's what the reverse mortgage gives the ability to do.
You know, when I'm talking to people who are working on their financial plans, home equity almost never comes up. Financial advisors aren't mentioning it. Some people are just not even aware it's an option. I was actually a speaker at Camp Pfau a couple of weeks back, and someone mentioned a HELOC. And after the talk, I had someone come up to me and say, what's a HELOC? You know, they were too embarrassed to even ask what it was. HELOC, for those who aren't aware, is a home equity line of credit. So what is this reluctance, you think, for people to engage with home equity? Is this an emotional thing? Is there a knowledge gap or something else?
I think it's a little bit of both. My research and experience tells me that, and this goes back, ad nauseum in terms of people owning homes. The goal was always to own my home, never have a mortgage on it. And that was somehow attached to security. And that's where the emotional part of it comes in. If I own my home 100%, I'm secure. Nobody can take my home from me. Well, yeah, they could. If you don't pay your taxes, they can come take your home from you. That's for sure. If you have some event where you're being sued, they can take your home. Nothing's ever 100% secure, but there was a sense of security. But if you really go back and you think about it, folks in the 1970s and even up through the mid 80s, if you were 70 years old, you had lived a long life, and your kids were probably still fairly young. And it was something you wanted to pass on to them. You wanted to pass your home on to them. And that was all tied to this whole security, emotional attachment, which gerontologists were concerned about. And what we obviously are seeing today is people are living longer and longer and longer. And if you're passing away in your late 70s, early 80s, your kid's house is well established. They're not looking to take your house. It now just becomes this hard asset that they got to liquidate after you pass away. We still have this emotional attachment to security that I own my home and it's mine. And really what a lot of financial planners, I think, just roll with that with their clients and don't question it because it's something that their client's rooted in. But we really got to change that paradigm. We got to shift the mental thought process there and say, hey, I built an asset. Just like I built my retirement money as an asset to help me during retirement, I built this hard asset, this house. How is it going to fit into my retirement plan? And there are options there, right? You could sell the house, liquidate completely, go move to a lower cost area. You could take a home equity line of credit in case you have an emergency, and that home equity line of credit, you'll tap whenever you need it. Or you can really build it into the plan with a reverse mortgage and say, hey, I can tap that equity whenever I need it, and I don't have to make a payment on it. So it doesn't affect the cash flow of the rest of my portfolio. Now you're really cooking. Now you're really working the hard asset of the house in conjunction with your more liquid asset of your IRA and working the two of them together to really stretch out how long you can maintain a lifestyle during retirement. I think that mind shift hasn't quite caught on yet. I see more familiarity with reverse mortgage now, but that whole mindset that I built it, this is an asset that I can use in retirement. It's taken a while to get there.
For me personally, I'm financially independent at this point. I know I'm on the younger side, but part of my plan was paying off my mortgage, which I did. I didn't pay it off right away. I wanted to benefit from interest deduction credits and things like that for a while. And it made more sense to put payments other places like investments and stuff. But eventually I paid it off fully because I didn't want the stress of a mortgage payment and a financially independent life. But after I paid it off, I did open a home equity line of credit, and I have one still. It's still there. I don't owe anything on it. And I actually ended up tapping into it one time because I needed a certain amount of money, and it was easier to use that and pay it off than it was to go in and liquidate stocks or tap into my other cash reserve. So I actually found that it's already been useful for me once, and it's still sitting there. So I'm curious, for someone who isn't been taking these steps though, especially someone who might be older and whose home has become maybe the most lucrative asset that they have, but they're afraid to tap into it, maybe because they paid it off, like you said, and they have that security there, but maybe they're struggling with minimal retirement savings, for instance. What options do they have here? Should they just be going out right away and just doing a home equity line, or is this where the reverse mortgage starts to come in?
Yeah, this is really that pivotal decision-making point on whether to do a home equity line of credit or a reverse. And really what you have to look at there is, okay, if I get a home equity line of credit and now I tap it, well, now I've created an expense and I have a fixed income, and now I've created an expense that's going to bite into that fixed income. For some people, they can do that. That's okay. That fixed income can absorb it. For some folks, that's going to put them behind the eight ball. So if you go at it and you tap into the house using a reverse mortgage, the reverse mortgage has no payment. The interest defers, so the loan balance grows over time. So it will bite into the overall equity of the house long term, but you have no payment, but you have access to the cash. So I really like the home equity line of credit version of the reverse mortgage. There are fixed rate lump sums and things like that. But I tend to find you have more flexibility with the line of credit option because you use it when you need it. I mean, think, for example, if we end up in a period of chaos with the stock market where it's not a great time when you're not contributing to your retirement assets anymore and you're drawing from them and the stock market's really taking a hit. If you can defer over to the line of credit on the reverse mortgage to supplement your income and not take money out of your retirement assets, you're able to really balance out a sequence of returns there that enables you to get over a downturn in the market and not do a lot of damage to your investable assets. You always have to take out your RMD, but your RMD can be reinvested if you're pulling your income off of the reverse mortgage line. And when the stock market returns, which it always cycles through, it cycles back over, stop pulling from the line of credit, go back to pulling from your reverse. You have a really good way to balance out your return on investment and making your saved assets, your IRA, last longer by balancing it out with use of your home equity. I mean, that's just one example of how it can be used. A lot of clients that I talk to, they come into retirement with a mortgage balance. And usually because they either paid for a kid's wedding or their education. And so they took out money they didn't expect to have to take out late in the game. And for a lot of them, that housing payment is making them draw more money, faster money out of their IRA. Well, here you have this line of credit you could use to liquidate that loan and have no monthly payment and slow down the draw off of your retired assets. So it's a solution that can be applied a number of different ways, but it's finding a way to get that equity to work for you, I think, is what's really important. And a lot of people just don't think that that asset can do it.
Yeah, you just outlined a few different scenarios, actually, ones that are usually challenging for people and how this could be a useful financial tool that honestly people are missing. You wrote about that in your book as well. You said despite over 1.3 million Americans having used a home equity conversion mortgage since 1990, the reverse mortgage still remains deeply misunderstood. And then you had written about some persistent myths, such as the banks owning your home, or the reverse mortgage being too expensive, or that the bank owns the equity, things like that. So can you walk us through a little bit more what the reverse mortgage actually is, how it's actually working, and what people are getting wrong about them?
Yeah, I think oftentimes people overthink and they listen to too much outside noise. If you got a mortgage out to buy a house, there is really very little difference between a purchase money mortgage to buy a home and a reverse mortgage. The big difference is you're not making a payment on a reverse mortgage. That payment is accruing on the loan balance. So if you make a purchase, you're paying it down over time. If you take out a reverse mortgage, it's growing over time. If you grasp that, that's 100% of the differential. I've had plenty of people really miss that. They couldn't figure out how that worked. And it's called a reverse mortgage for a reason. It's opposite of a regular forward mortgage. When you purchased a home, that's a forward mortgage. You borrowed a certain amount of money and you paid it down over time. Maybe paid it off completely. The reverse is doing the complete opposite of that. You're going to borrow money. It's going to grow over time because you're not going to pay it. You're not going to put any money out monthly for it. If you grasp that, that's the big differential between them. Everything else about the loan is the same.
Let me see if I'm grasping it for a moment because I didn't do one of these. So if I were to take out home equity as a loan, I'm taking really a full lump sum of equity all out at once that I have a fixed interest rate against, that I then have monthly payments. Basically, I owe that whole balance. I have to pay back some interest payment every single month on that full balance until it's gone. For the reverse mortgage, it's like a reverse of what I would do paying a mortgage where I own a balance. I'm taking out something every month, not the full balance all at once, but the interest is piling. So I don't owe anything. So eventually, though, I would owe whatever the accrued interest would be based on how much I ended up pulling out. Am I getting it right or am I missing something?
Yeah, no, that's right. So if we use an example where on a reverse mortgage, you took $100,000 out. If you look at current interest rates right now, if you used $100,000 of the line of credit, because you're only going to accrue interest on what you use. But let's say you use $100,000 and you don't use a dollar more after that. It's $100,000. In about 10 years, you'll owe $200. It'll double at today's interest rates. So you'll take out $100. In 10 years, you'll owe $200. When you sell your house, you pay off the $200,000 mortgage. If you pass away, your heirs, when the house goes into the estate, sell the house, pay off the mortgage. No different than if you had a mortgage balance remaining on your house from when you purchased it. The same thing. You have to pay it off. When you pass, it's like paragraph 5 of every note, beneficial interest. You pass away, it goes to your estate, estate's got to pay it off. That's true in any mortgage, whether it's a home equity line of credit, a reverse mortgage, a purchase mortgage, same paragraph applies on all of them. So that's the trigger points for a reverse. How does it get paid back? When you pass away, house gets sold, pay the mortgage back. That's one. If you go into long-term care, this is a differential from any other loan. If you go into long-term care for 12 months or more, the assumption is you're not coming home. 12 months in a long-term care facility, you got something serious going on. You'll need to sell the house, pay the loan off. If you don't keep up with your taxes and insurance and you start missing and you can't negotiate something, you just keep missing on those payments, you're going to have to sell that and pay off that loan. But guess what? If you had a regular mortgage and you weren't escrowing taxes and insurance and you missed tax payments, you could lose your house. So it's no different. You'd have to sell it and pay everything off. Those are the 3 main trigger points on a reverse mortgage. And that's the question that I get is, well, the bank owns my home. No, they don't. You own your home. You're entitled to that property. When you hit a trigger point, The bank now has to get paid off. No different than any other loan. You hit a trigger point, you got to pay them off, or your heirs have to pay them off. That's kind of that main difference there. That we go through with a reverse mortgage. Now, one of the other questions that I've been given is, well, and this came from financial planners, by the way. Well, whatever remaining equities in the house, after a client's taken out a reverse mortgage and it's been building up a balance over years, that remaining equity goes to the bank. No. That remaining equity either goes to the owner when they sell the house or it goes to the estate when the house is sold.
It sounds like the misconception is that people think once you do a reverse mortgage, the whole asset is at leverage. But isn't it just the amount?
It's just the amount, whatever that remaining balance. And I can tell you that I've been doing some proposals recently for people at current rates. And that balance, whatever you take out, is over a 10-year span is going to about double because it's reverse amortizing. We all know that if you take a 30-year mortgage out, you're going to pay about 3 times the value of the house when you bought it, 3 times the mortgage amount. And this is just work as a reverse amortization. It's doing the same thing. It's running up at about the same pace as a 30-year mortgage is interest led in the front. You're adding that interest to the back end of a reverse, but you always own the home. And you always own the remaining equity. And one of the key things is, and this was we'll talk a little bit about where some of these misconceptions came from, but these loans go through an actuarial table. So how much money you can get out of the equity of your property, how much of your property you have access to on a reverse is determined by whatever the current rates are, what your current age is, and the value of the home. 3 pieces of information. Your age enters into the actuarial part of it. So the younger you are, the less equity they give you because they want you to have equity at the end. The bank doesn't want the loan to exceed the value of the house at the end. So they've designed it so that there's still equity left. Now, I've actually had some clients outlive it. They took them out when they were 62 and stayed in the house till they were in their 90s. But then there's an insurance that comes with it that helps pay that. So it does still help the heirs get out from under when they have to sell a house. But yeah, that's a key piece. In 2014, there were changes made to the reverse mortgage. One of them was recalculating actuarial tables because they were off. They hadn't been recalculated in a while, and they found that they were giving too much equity out on the houses, and the houses were getting to that tipping point of maybe the loan exceeding the values. That was a major reform in 2014. There was a few others, and one of them relates to this: does the bank own your home? And there's a story that I recount in my book, and I'm from the Philadelphia area, and there was a player who played for the 76ers, Caldwell Jones. And when Caldwell finished ball, he went back to Atlanta, which is where he was from, and he had a house with his wife. And he was young. He was about 62 when he took out a reverse mortgage. His wife was younger than him. Now, back prior to 2014, what any loan officer would do would say, okay, we're going to put the mortgage just in Caldwell's name in this case, because his wife couldn't qualify because she was under age 62, which was the qualification point for this loan. They were doing an FHA-backed reverse mortgage. Unfortunately, about a year later, he had a heart attack and passed away. Now, the bank came knocking because what did we have? We had a trigger point. The borrower who owned that mortgage passed away. Mortgage has to get paid off. Those are the provisions of the loan. That's what he signed up for. So when they came to the wife, they said, okay, you can write a check and pay us off, or you can sell the house and pay us off. And she didn't want to do either. And so she was scrambling and actually went, and this was a court case, and it was a landmark case in reverse mortgages because she was suing to keep ownership of her house. She wasn't working. She couldn't qualify for a conventional loan. So everything was working against her. In the judge's opinion on the court case, she lost the case. But the judge said, hey, the servicing bank on this loan is correct. They did what they were supposed to do. They had to foreclose on the house and get paid off. That's what they've agreed to with FHA. And the judge said, I never in my wildest dreams don't believe FHA wanted to take your house from you. They never looked at this possibility in doing it. So the law changed in 2014 based on that case. And they have what's called a non-borrowing spouse. So if you have a spouse who's underage, they become a non-borrowing spouse. They can stay in that loan until they hit a trigger point. They die, go into long-term care, or sell the property. And that was the misunderstanding of the banks coming in and they're taking my house. That's where I could tell just from the way people explained it to me. That's how it all spun out. There were enough cases that enough people heard about of the bank coming knocking to take the house. And it was primarily because they didn't have that provision built into it to help protect the consumer. And one of the other things, I'll just throw this out there too. People used to just get a reverse mortgage. They go sign up, get a reverse mortgage. That practice stopped in the sense that every borrower has to go through a HUD certified counseling session anytime they're getting a reverse. Me as a loan officer, I can't even take the application until the client goes through that. So I'll do a proposal, explain the proposal, then they'll go through their certification with HUD, and HUD will say, okay, yeah, they understand how this works. Go ahead and do the loan. They've even tried to attack it from that end. Even the private equity reverse mortgages require it as well. And I think it's a good practice. So everybody's on the same page about how the loan works.
I read that according to the AARP, that nearly 90% of adults over the age of 65 actually want to remain in their homes as they age, because, the cost of aging in place, though, it can be a really difficult thing financially. It actually can be financially unsustainable for a lot of people if you don't plan for it. I know this is called aging in place because it's such a powerful financial tool and one that people have misconception on and miss so often. How could things like staying in your home for the long term, but having all that equity locked in place and you're not going to sell it, should people be putting this into their planning right away, or is it kind of vary depending on situation?
Well, I think most retirement economists suggest that you start the reverse mortgage as early as possible, particularly if you own your house outright, to get the home equity line of credit version. And there's a reason for that. If you went out to get a line of credit and you borrowed $100,000, do you have access to $150,000? No, you have access to $100,000. In a reverse mortgage, every year, the unused balance of that mortgage grows. So it allows you to grow into the equity of the house. And so the retirement economists, when they've done their numbers, they said, well, if you get it young and you don't need it yet and you're not using it, it's growing. And it's going to grow with, it's a set amount every year that's determined through these actuarial tables. So you're always going to have a larger access to equity. If you take it out at 65 and you don't use it until you're 75, you might have taken a $150,000 home equity line of credit reverse mortgage and it's now worth $250,000. And you didn't have to do anything but just let it ride. So whether you get it young enough or whether you wait, I don't think it's a bad idea to get it when you're on the younger side in retirement, particularly if you own your house outright. But for some folks, it's a matter of placement, when they need it, how they're going to use it. If you look at people that want to age in place, they ultimately, they're looking at the retirement home as a non-starter. They don't want to go there. And for a lot of people, it's because they live near their kids. They live near their grandkids. They want their grandkids to have a place to stay. They want them to be able to stay overnight. It's a lot of lifestyle. And I don't mean lifestyle in the sense of spending money. It's lifestyle in terms of spending time with family. They want their house to be the focus of that. And they want to be able to use their house in that way. And so aging in place is partly that. And it's partly having that secure feeling like, this is my house. This is where I live. As I'm sure anybody who's in the financial services knows, as you get older, your medical needs get tougher. You're going to need more care. If you need full-time care, it's $12,000 a month for in-house care where I'm from in the Philly area. And it's more expensive in some areas, a little less expensive, but it's in that range where we kind of sit in the middle spot. If you needed full-time care at home, $12,000 a month, you go into the nursing home, it's 16. So it's expensive either way you go. But you can advance into that. And that's what some of my clients do. I have clients that are in their late 70s, early 80s. Maybe they're not getting around as much. They're having somebody come in and do shopping for them. That's a couple of days a week. Help them clean the house a couple of days a week. So they're spending a few, maybe $1,000 a week, $800 a week to get some help around the house. And it makes the house more manageable for them over time. So where you are in that continuing of aging and where your health is has a lot to do with, is aging in place practical, and does taking a reverse mortgage make sense? Now, I could tell you the opposite side of that. I had a client her father, he knew he was starting to have dementia. A doctor and him talked, and he talked about it, and he asked her, don't put me in a home. If the last thing I ask you, do not put me in a home. And they kind of spent down his retirement money to where they had about a month and a half left of in-home coverage when they were referred to me by their financial planner. But he had a pretty significant valued house, over $600,000. He was going to have access to about $350,000 of it on a reverse. And we ended up doing a lump sum reverse mortgage for him. And that basically gave him about a 2.5-year runway of full-time coverage. His doctor didn't think he would last much more than 18 months. So we kind of overcovered, got enough money to do it. And so, they've been making that $12,000, $13,000 a month payment to have full-time in-home care for him.
Yeah, I can tell since we started talking about this, how this is a financial tool that could help in many different scenarios, because I think so many people think of our homes as these liquid things that maybe we'll get a windfall out of, but it doesn't have to be that way, especially if you're in one of those tough situations. So for listeners who are interested in learning more about this or connecting with you directly, how can they find you?
So I have a landing page, www.kineticwealthbook.com. You can land there. You can order a copy of my book. All my contact information's there. I'm perfectly willing to talk to anybody about their situation, even if it's in a state I'm not licensed in. I love the educational part of this. And, the fact that I can help somebody make a good decision about whether they should look into a reverse mortgage and how it could help them. I love the world experience I get talking to people, because it becomes more relatable as I talk to different people. The more scenarios that I get to hear, the more I can relate. Because as you said, it's general in terms of a product, but it can be applied very specifically for everybody's individual situation. So I just love to talk to people and just brainstorm ideas about how to use it.
Well, thank you so much, Ken, for coming on the show and sharing all that with us. Appreciate it.
All right. Thank you, Daniel. Appreciate it.
In my conversation with Ken Pitts, what stayed with me the most wasn't the math or even how badly we misunderstand the reverse mortgages as a country. It was actually one of the stories that Ken was telling about one of his clients. It was a man with dementia who, before his memory had slipped, had made his daughter promise to keep him out of a nursing home. She watched his savings drain, trying to honor that promise. $12,000 to $13,000 a month really adds up. Those bills just kept coming. And by the time she got referred to Ken, he said that she had about 6 weeks of in-home care left in the account. She was going to default on that promise. And the man owned a $600,000 house. And until that referral, no one had told her that the house could help pay to keep him in it. Ken put together a mortgage that pulled $350,000 out of that equity. That bought the family 2.5 years of full-time in-home care. So they were sitting on this pile of money that most people miss. And tapping into that allowed the daughter to keep her promise to her father. And the reason I keep thinking about that is because most of us are walking into retirement with the same kind of asset sitting right under our feet with no clue on how to put it to work. For me personally, I did figure that out a bit earlier than most, because I had paid off my mortgage and then I turned around and I opened a home equity line of credit. And I actually ended up using it once when I needed some cash. I needed a large lump sum. I had savings, but I was getting a good interest rate on my high yield savings account. So I didn't really want to draw it down. It was providing good passive income. And the low interest rate on that HELOC actually made more sense than losing the returns I was going to be getting otherwise. So I ended up taking that loan instead of drawing down my high yield savings, or even worse, liquidating stocks that I wasn't ready to liquidate. That was great. And then that HELOC got paid off in a couple months, and it's still sitting there today. It's a tool that I have ready to work for me in my plan when I need it. So when Ken started talking about this reverse mortgage as the same kind of tool, but just designed for a different stage of life, it actually clicked for me. The mindset is different here. Because most Americans are, we treat our home as part of a balance sheet, mostly a liability because it's expensive, and something that hopefully will one day turn around into be an asset for us. But it doesn't have to be a liability and then this illiquid part that might at best become part of our legacy. Some kind of safety net for our kids, this thing we don't touch, but maybe someone else gets something good out of it. And the truth is, the data does show that very few of us do put this to work. Last federal fiscal year, the FHA insured exactly 28,172 reverse mortgages. That's 28,000 reverse mortgages across the entire country for the entire year. Now, in the same window, roughly 4.1 million Americans turned 65. That's the largest annual cohort in U.S. history. So do the division. For every American walking into retirement with a home that could carry them, fewer than 1 in 140 put that tool to work. So why? Well, part of it's probably that inheritance promise. Most of us were raised to believe that the highest form of love a parent can show is to leave the house behind, free and clear and untouched. And that did make a lot of sense in like 1975, when you died at 70 and your kids were 35 and just starting out. That's a huge asset for someone at that phase of their life. So in 2026, time of this recording, many will live to 90, and that means the kids are in their 60s. And what they actually need at that point is not a paid off 4-bedroom. It's more than that, though. Part of it is also the mythology. And Ken did his part to clear up a lot of the misconceptions. First, the bank does not take your house. You still own your home. The same way you own it when you have a regular mortgage with a balance left on it and you're buying into that equity. Whatever equity is left when your house sells goes to you or to your estate. The non-borrowing spouse protection that wasn't there before 2014 is there now, and it's codified after a landmark court case that Ken covered. And every borrower has to now sit through a HUD certified counseling session before a loan officer is even allowed to file the application. So protections are in place. They're trying to make sure it's safe and that, your home, this important asset, is being leveraged properly. And that income that you're getting for yourself to cover things like that shortfall in cash flow or retirement savings will actually do what it's intended to do. So none of this is the Wild West. It's actually one of the most heavily regulated products in consumer finance. And the other part is just about the bad instincts about the math itself. People hear that the balance grows over time and that can create some panic. But look, a regular 30-year mortgage costs you roughly 3 times the loan amount by the time you're done paying it off. A reverse mortgage takes a balance and roughly doubles it over 10 years. The math isn't that different. The direction's what's different. And then there's the trade. So no monthly payment in exchange for a balance, the house eventually settles when it sells, is one that will work for the right person at the right stage of life. And so what about those of us who care about FI? How might this work in that greater strategy? Well, there was a leading retirement income researcher, Pfau, who did some work that showed that retirees who pulled from a reverse mortgage line of credit during portfolio downtimes, instead of selling investments at a loss, can end up with hundreds of thousands of dollars more by the end of a 30-year retirement. In one of his case studies, the gap between using a buffer asset, like a reverse mortgage, and not using one was the difference between running out completely and finishing with $4 million left in the account. That changes the conversation. The reverse mortgage is not a last resort lifeline for desperate retirees. It can be a portfolio protection tool, deployed strategically by the people who planned ahead. And then there's also the line of credit version that Ken had mentioned as well. That one can actually reward the person who opens it early and then leaves it alone. So it can even make sense for someone at an earlier stage, because that unused balance would just grow every year. So he had given some examples, but like, let's say you opened a $150,000 line at 65 and you ignored it for 10 years. So you do it later in life. By 75, that could be up to $250,000 in available credit. That's the exact opposite of how every other financial account behaves when you leave it alone. The last consideration has nothing to do with a sequence of returns risk and everything to do with the bigger picture. 9 out of 10 Americans over 65 say they want to stay in their homes as they age. 7 out of 10 will need some kind of long-form care along the way. The median annual cost of a private room in a nursing home is now over $127,000. And a home health aide running 44 hours a week is nearly $78,000. The gap between what we say we want in our last years and what we have actually funded to make it possible, that is the gap a reverse mortgage can help bridge. So for the question of whether a reverse mortgage is a good loan or a bad loan, well, I think that was a fair question in 1995. I do think the question in 2026, though, is whether that the biggest asset that most of us will ever build, we will allow to do the work of carrying us through that last quarter of our lives or not. It's just a decision to make. We have options with the ability to keep the promises that we make to the people we love. I'd love to hear from you. What might you fund if you were to tap into that home equity? How much further might that push you to your FI goals? Email me at contact@escapetheclock.com or leave a comment wherever you listen. I'm Daniel C. Rogers. Thanks for listening. Best of luck putting your biggest asset to work, escaping the clock. I'll catch you next week. That's a wrap on this episode of Escape the Clock. Everything you've heard today is for educational purposes only, designed to help you think, plan, and build a stronger financial program. Take what resonates, bring it into your Escape the Clock plan, and review it with a qualified professional before making any major moves. The book, the free planner, and the one-on-one time with me are all waiting for you at escapetheclock.com. If this episode was valuable, please leave a rating, share it with someone who needs to hear it. I'll catch you next week.